severe clear in Wichita, temps in the low 60s. And but it feels different when you're outside now. You know that your body is losing heat, not gaining heat like it does when the sun is higher up on the horizon. So anyway, we had a great weekend here. Tennessee, even though they lost, did show some improvement, but poor Kansas State got whacked by Oklahoma after they managed to figure out how to lose to Texas Tech. So upsets, revenge, all sorts of stuff on the football field this weekend. You know, we left last week wondering what the big deal was about the settlements that came out of the EU. I mean, it was long on promise, short on deed. And again, they had managed to kick the can down the road till this week's G20 meeting and supposedly another announcement out of the EU on the 3rd. So politicians do best what politicians do best. They talk and they try to sweep problems under the rug until the next accounting period or election, and that's where we are. So the news coming out over the weekend was pretty hard on what they'd actually come up with. The tangibles are 440 billion EU euro currency committed to the rescue funds. Banks are voluntarily to take 50% haircut on Greek debt. No mention of Italian, Spanish, Portuguese, or Irish debt. And if I were in those 4 countries, if Greece can get 50%, maybe I can get a lot more than is on the table right now. The European banks by next June, again voluntarily, have to get their capital up to 9% to be able to absorb these write-offs. They don't really say how they're going to get that up to 9%. If the European banks, which are already valued with 50 to 60% haircut on PIG's debt, go to the public to raise money, there will be pretty severe dilution of owners' equity. So China was to be approached by the France, India, and Brazil. Apparently, China has told them no again over the weekend. So my guess is like it's been from day one, is implosion. I mean, you'll just get to the point where you can't. They'll keep borrowing money until they can, and they'll get to the point where they can't borrow money, and it's over. And then they'll have to pick up the pieces. These are very, very tough decisions for politicians to make. If you look at a comparative situation in the United States with the, on paper, with this, I forget what it's called, baseline budgeting, I forget the exact term, but our budget is to increase every year 5 to 7%. And if you cut into that 5 to 7%, then the press and the politicians scream that you're actually cutting our budget. And you and I know that when we cut our budgets, we cut back on spending. We don't cut back on the rate of growth in spending. So the issues facing all these governments are the same. Their social programs and entitlement programs have gotten way out of hand. And at some point, they either voluntarily cut back or the system collapses. So thanks, Bill. So again, because it's easier to kick the can down the road because everything is built on what's in place today, there's very little political will to do what has to be done. And the way it usually resolves itself is that the government collapses in a parliamentary system. Then because of they can't refinance or they don't have a budget or whatever, and a new government is voted in. And in our system, the governments are replaced every 2 to 6 years, the governing body. So we'll see how that shakes out. But anyway, for us as traders, what it means is that we're going to get big swings in sentiment from bullish to bearish. All it takes is upticks or downticks to kick off high-frequency buy or sell programs, and we can benefit on that. The go with tendencies of these markets has increased to the max, if you know what I mean. And executing with limit orders at the edges becomes, or the perceived edges becomes a riskier proposition rather than buying breakouts or selling breakdowns. So we will see how to play it. Now, looking at this screen, the 24 was the high on last Thursday. And then if you go look at the day session high on Wednesday, it was 29.04, 29.05. So this 28.24 to 29.04 area is pretty stout resistance. I don't see that we have the news to break us out today unless Chicago PMI comes in way lower than currently forecast. And that's not likely because it's the center of the automobile industry. So you had stage 1 development down. You had development probably right here. And now we have stage 4 that's gone back to retest this high. So we've got to get through 24 to get back up into this area. And you can see we have an I period high at 29 and a D period high at 29.04. So we know in the day session that's this 29 to 29.04 is where the market has rejected prices, and last week we rejected prices above 24. So while I would like to sell failure in this area, basically leaning against this, 24 might be it, and we may, when we get these last little spikes in the overnight session up or down, quite often that's the high or the low. So we'll just have to see how the market behaves when we get back up in that 24 area. On the buy side, the breakout was at 10, 11. We have volume at 12 to 15. So the buy side, you have a 13 to 17 buy leaning against this volume. And then our next buy zone would be leaning against this single print would be the 5 to 9 area. And then at 9:45 Eastern, we've got the Chicago PMI. So we will see what the market brings, and if the E-mini sells, and I think it will, then we should have, at least a retest of this 24 area and perhaps higher. Now, if the market fails to trade above 20, you can already see that we may be dealing with rejection right here. So the issue first for us is what happens in this 20 to 24 area, and then what happens at 29 to 29.04. I see John Corzine. Yeah, you wonder. I guess he was a wonder boy when he was at Goldman. But these guys, when they get out of Goldman, ability to do anything but bleed systems is pretty minimal. I saw Interactive Brokers took them over, and what happens in the industry is that everyone's accounts are held in trust and guaranteed. That cash that's in your account, MF Global can't get their hands on. The way that they'd have to do it would be through false statements showing you that there was money in the account and them stealing it. So firms disappear overnight like banks do, but the customer's accounts just move from one house to the other. And ES makes a great point right there. So much of what's done out of New York is based on inside information and rigged games like back in the 90s and the early 2000s, Goldman would put out a bad research report on a company and they'd run the stock price down, and Goldman was the buyer all the way down, and all of a sudden their opinion on the particular company would change. Everybody that wanted to sell it sold, so they held the inventory and prices had to go up. Goldman is a treacherous firm to do business with, and they always have been. I always like when Salomon Brothers were out there. Before Buffett bought them, Solly or Plazas in the futures side would tell you, yeah, we're going to corner the 2-year market. What are you going to do about it? And the battles would be fought, but I mean, they were pretty open about what they were doing. It was a fairly easy read. But Goldman's a bit closer to the vest with their information than Plaza and Salomon Brothers were, and I guess that's why they've done as well as they have done as far as the income statements go. But you have to remember, the whole Chicago industry was built on front running, seeing where the large commercial orders were, getting in front of those. And if you're wrong, you lost a tick or two. And in my opinion, the New York game is really, when it's all said and done, based on inside information. And you can just see how Goldman Sachs is just a kind of revolving door with Washington, D.C. It's where people go to get employed for 7-figure salaries after working in the government, and to give that beautiful landing after a paltry government job, they expect something in return. Okay, got a pretty clean break here at 16 to 17. The last rotate down was 18, so maybe we get stops below 18. We got the mean green line at 13, so this is our first buy zone. And then basically 9s or better. This is a big number. As long as that holds, stays above 12, we should trade higher. Okay, you all know from the news that we got last week that there was a lot of head scratching on my part and in a lot of the news articles that were shared about this is a deal, or what's so good about this deal. And so we came out of last week with more to come on November the 3rd, with more to come in June of 2012. Just all sorts of supportive, positive rhetoric. But I mean, the bottom line on the Europe is that they have put up 440 billion euros, and Germany has said no more. And then on Friday, I believe the German central bank, not the European Central Bank, came out and said it really doesn't make sense to use leverage and borrow more money to solve this problem, this was what caused the problem. So Northern Europe is kind of digging in their heels right here and really saying, you know, how much more good money are we going to put after bad? What kind of a transition is going to buy us? Greece shows their appreciation for what they do by rioting and saying it isn't going to happen. The riots have started in Italy. Spain and Portugal have been pretty quiet. But if they see that Italy gets more by burning cars and marching in the street and breaking windows, don't think those two countries would be too far behind them. Okay, one of the things that back when I used to speak publicly in the 90s and early 2000s on daises or forums put out by CQG, I would get asked, and the markets were usually open. These things would usually start about 1 in the afternoon, or if we did one after the markets had closed. Which way was the market going to go? And I focused on the skewing in the congestion area. And you can see right here from a volume standpoint in the congestion area, it's pretty clearly a B. And you've got what you would connotate as supply right here starting what at 79, 78, or 79. So we open at 79 or 80. We get this little spike up. The two-letter ledge basically holds. And then we've got ourselves a B pattern followed by another B pattern. And we've got a single print down here at 58 to 60, and then we have these single prints down here at 45, 47. So while we're dealing with a pretty strong P, we had hints on Friday that the market was heavy, and that's confirmed by the overnight session. Now, profit taking or new selling is the issue. If it's profit taking, we can come down into this area and find buyers. If it's new selling, we ought to get through this in a hurry. And the Chicago PMI number at 58.9 is highly tied to the health of the automobile industry. And I haven't seen where the inventory figures were, but in September, General Motors had 123 days of inventory. And you see a lot of 5 and 6 year 0% loans out of General Motors right now with some cash back or with pretty nice accessory packages to move those beasts off the lot. So this Chicago PMI number, if it's like the most recent economic activity numbers, could come in greater than 60. And if it does, it will support the stock market. It should bring a little rally. But then you're back to what's going on in Europe and how does it impact us. The biggest thing this week is the G20. If China has turned them down, Brazil's already said no. I haven't heard what India's going to do, but I doubt if they'll put any money to it. Then it's down to the U.S. and the IMF. So my guess is that we'll get a supportive statement out of G20, but no hard dollars, and it's back to what the U.S. can do. So, I mean, the U.S. is in the same situation the EU is. We're printing money. And the way our government is handling this problem is that they're printing money. And because we have a currency, we can do that. If the EU starts to print money, then that's how they choose to handle it too. And that's historically been the way that prolific spending has been swept under the rug, is that you is through inflation and the devaluation of your currency. Now, for us in the United States, who can grow our own food and given time can manufacture everything we need to manufacture, a weak dollar for those materials that are not purchased outside of our country doesn't hurt you that much. I mean, the economy will go on, but for those things that we import and will continue to import, it will hurt us. And so it's, again, they're just tough decisions to be made, and we don't see a lot of political courage. So basically dealing with a B here and a B here, and we're going to my guess is we'll probably get a test of the 1250 area before it's over, before we know what we have. Okay, I did some work with Pete Stedelmeyer's volume strips over the weekend. And his conclusion is that the profile doesn't work as it used to, where you would have a willing community that would buy below value and sell above value. His conclusion is that markets are self-generating right now. They're basically go-with markets like the E-mini, and it's pretty close to the way that we've been playing them. He emphasizes these volume strips, and he says what you have to look for in the distributions are these volume nodes. And when the market breaks, say, resistance right here, it goes to the next volume node where there's supply. And he says these volume nodes are where you engage the market, these high volume numbers. And he was talking specifically about the grains and the indexes and the currencies. He did not mention the note or the bond, but we know this in what we're doing. And then the other thing he says is that as you approach these volume nodes, he says between these volume nodes, you got high volume here, high volume there, and volume decreases. And if you get up into this node right here and you've got volume increasing, you should break it out and take it farther. If you get into these nodes and you see the volume start to decrease, then there's a good chance it's going to hold and come back in. So really what Pete is identifying is that you've got these areas of supply, and the market doesn't spend a lot of time between them, and that you're dealing with go-with markets. So again, our idea that our patterns, the skewing of the distribution inside the patterns, when these breakouts occur, if they come back and the breakout holds, that's when you want to get on board. Really fits in pretty nicely with what he's doing right now. So he talked in terms of how much volume it takes to, stop a market and turn around, and I'm sure over time they'll be developing guidelines which will be gamed by exchange members. But the very, very large traders, people that will commit large amounts of money to securities of any type or derivatives at certain levels, are those that are controlling the market right now. And it's this initial commitment where they'll take all the bid or they'll take all the offers out and slow the market down, is where these volume nodes build. And there's not much in between those. So I was pretty pleased after going through it that our ways of trading the market and the way that we're looking at it took that into account. And when you think about how we look at a market inside a congestion area, like if we have one of these previous volume nodes like this, if we build volume in the top half, we're going to retest the high end or go higher. And if we build volume in the bottom half, we're going to retest that low and or go lower. So I just think, again, by reading the skewing in these volume nodes, or areas of supply as he calls them, gives us a pretty good hint as to the market's next direction. And we've, especially in this contract, are already go with traders. So I'll have to think about what he's saying in relationship to the note and the bond a little bit. But on this particular contract, we've had selling. We still have it, but you can see that it may be slowing down right now. We've had a retest of this low right here. And if we can't get through our 70 area right here, then we should get back and retest this 67 area. 65, 67. is where support is right now. If we break that, it is 58 to 60. And then ultimately 45 to 50. And we've had a pretty nice run from 1070 to 1290 in anybody's book. I think the month of October showed 20% gains. My guess is the selling will not get out of hand today, but if we can't rally the market up early, that we'll be dealing with long liquidation as people lock in October profits. So our first sell zone, and it's fairly aggressive, is 69.50 to 71.50. Our second sell zone is up here. And then we got to crack 65 to stay with the trade. If we can't crack this 65 area, then we'll have to rethink it. The Chicago PMI news is at 9:45 Eastern, so it is a ways around. We'll have to see what we've got right here and play it from that, but I do like the short side of the market first. Any questions? Okay, 18 held on the note. We didn't get our 17 buys. We're back up to 2021. Maybe we're being gamed now by the CME and their market letter. Well, here we are. We'll see the note and see what we've got. Come back down, see if we can get in at the 13 to 17 level to retest 24. You know, the Don Jones, Pete Stedelmeyer, and now Tom Alexander say the profile doesn't work. And they're talking about the model of the profile that was taught as it's evolved through the present day right now. Right now, high frequency trading has really changed the way the market does trade. 70% of the volume is based on high frequency trading. Then where are the areas where you're not going to get upticks or downticks? They're going to be previous areas of supply, or these little volume nodes that we've identified. So there's two reasons for them doing it. Number one is to sell their new programs and to recreate interest in what they're doing. And Pete's been a master of doing that over the years. And you can't, I mean, I don't blame him. I mean, Pete's my teacher, my mentor, and I follow what he does closely. But, you know, if you can be right 3 weeks in a row on both markets, on which way the market's going and the rest of it, what we're doing is not too far off the track. So I think what we've picked on the room is this breakout trade. And we've always had rule number 2 about high volume areas. And the way that we look at a high volume area is that if it's immediately rejected, the market's pulled to it and it's immediately rejected, that area has been used, is being leaned against by large traders to enter the market from the long or short side. If it is accepted, then you trade around it for a while until it gets ready to break out and move from there again. So I think our emphasis on low volume, high volume, and moves out of middle keeps us on top of what they're doing, whereas traditionally in the profile, what they've talked about is that here's value and it's okay to buy it here and it's okay to sell it here and it's okay to build positions all the way down buying it in here. But I think our mom protects us as long as we don't have a mom situation. That means we're basically going back and forth across the value area. So I think we have rules and guidelines built into the way that we look at the market that keeps us from getting in trouble as the traditional profiler might get in trouble. But Pete's deal on the profile now, Rich, is that it leans on, as opposed to looking at distributions like this, what Pete is doing is that he's breaking out these volume nodes, and he says as you run between them, the volume, it's a convex distribution. It's not a concave distribution. So he sees multiple distributions throughout the day, which would be our little volume nodes that we talk about, and you move from one to the other pretty quickly until you've exhausted the buying or the selling. So I don't see that much has changed, but I've just started digging into it, and I will keep you posted. Again, the proof is in the pudding on the efficacy of what you're doing, and if we get the direction of the market right and we trade from that direction most of the time, then I mean, what else do you really need to know? And I think we do a pretty good job of getting the direction right. So over time, the way I've worked with a profile has certainly evolved, but I really spend, like most people when they look at the profile, they will see a P. When I look at the profile, I see a tail, and I look inside this distribution area to see if it's a B or a P, and then whichever way this is gives me the next retest and or lower, the next retest and or higher. So I don't think I'm gonna. Well, yeah, I mean the market. I mean all of really what we have really invested or bought into is which is the next move of the market, and we got a lot of pretty powerful tools to do that. Which way is the volume going? Is the cumulative buying or selling going that way? When we break out, do we kick off a lot of volume when we break it out? Or do we kick off no volume when we break it out? So, I mean, a lot of the things that we look at, we're on top of that market. Now, what I got out of Pete's talk to the CME is that Pete is willing to fade the markets in these high volume areas, plus or minus so many ticks, to secure a good trade location, and that's kind of like our rule number 2 trade. And so I really think that through evolution, or through the pain of losing money, paying attention to what happens in the high and the low volume areas, we've been on top of that for a long time. Any other questions or comments? I mean, my job right now, and scratch my head and look at it, is that am I on the right page? Am I doing are we following what the market's doing, or am I in left field or starting to get into left field? That's what I have to go back and figure out. So I'll take a look at the literature that they have and see if it makes sense to me. I'm not saying that Stettlemeier is wrong. I'm just the way that I'm going to look at it is what do we have to change if what he has surmised is correct. Later.